Hello, my name's Sean Brew. I am the head of the London business at Lambert Hampton. The area that I want to talk about is what are the main drivers of commercial property performance over the medium term in the UK, and particularly look into two areas. Where are we now in terms of the cycle, and what are some of the characteristics? And within that, the second point being, from here, what's important in investor returns over the medium term. So moving on to my next slide. At the moment, prime real estate is expensive against historical averages. We've overlaid the current position against the top of the market last time around, spring 2007 or thereabouts. And you can see that the yield profile is very consistent with the last cycle, and indeed in one or two occasions, or one occasion particularly, it is actually more expensive, and that's Southeast industrials for reasons we'll touch upon in a moment. This chart also reminds us how swift and dramatic the correction was over an 18-month period between the spring of 2007 to the end of 2008. Within this cycle, there's two interesting buying characteristics I'd just like to dwell upon. The first one is relating to London's attraction to overseas investors and continued attraction and the trading volumes. That's for a range of reasons, one of which is transparency, security and safety that the mature market offers. Weak pound makes it a cheaper option than previously. Risk diversification from overseas investors away from their home markets, and a continued belief in the success story of London as a financial powerhouse. The other area is local authority and alternatives. In this cycle, we're seeing an awful lot of buying from the local authorities. In 2006, 2007, it's about 69 million. Last year, there's 2.5 billion, so over 36 million, 36 times more than previously. And the other is alternatives. It was 11% of the market in 2006, 2007, and it's about a third of it now. And within that, I think there's some very interesting commentary around demographics and the healthcare sector, particularly with our aging population and the attraction of long-term leases and RPI uplifts. We're seeing an awful lot more investment into the healthcare market. There's 1.3 billion in 2017, and a number of successful fundraisers from healthcare providers. The next slide reminds us that in this particular cycle we're seeing real polarisation of performance, and it also reminds us how intertwined property is with our everyday lives, where we're all becoming more familiar and comfortable with online retail, and the beneficiary of that clearly is the logistics and industrial sector, which supports into the online platforms, where we've seen stellar performance over the last 12 months, less stellar on the high street and the shopping centre, and there's a 25% swing in total returns between those two sectors for the shifting and changing consumer patterns. But importantly, looking forward on our next slide, where is the market going? Well, our forecasts are showing us quite conclusively that the most important part of total returns over the next 3 or 4 years are going to be coming from maintaining and improving income. We'll be in a place of yield tranquility as a general statement. So if we take that as fact, there's a fairly simple equation that income is driving total return performance, and within that, occupiers drive the income within the property, and therefore, if that's the case, logic suggests that occupier satisfaction is very important, and therefore that itself drives income. So if that's true, we then need to look at occupier and occupier mobility. And occupier mobility remains very high. Short-term leases across the sector, average lease length of about 5 years. Longer-term leases are listed in many cases with occupier breaks, and there's less locational inertia from occupiers. They're less wed to locations through increased personal mobility, assisted by technology and legislation coming in that will drive greater occupier nimbleness. So then we think about occupier satisfaction, which clearly is extremely important because income is extremely important. And all the surveys suggest occupier satisfaction sits at about 5 out of 10, with particular angst around service charges, environmental issues, the whole license process. So whilst 5 out of 10, I don't think anybody would necessarily say is good news, this does, however, present opportunity for more forward-thinking investors to do a number of things. First would be to engage with their occupiers more constructively. The second will be to seek to provide them with a flexible, responsive work environment that suits the occupier's needs. And the third would be to provide greater and better cost certainty to occupiers who uniformly want to minimise their property spend, as it's an incidental to their core skill of whatever their business actually is. So that approach will help, certainly in a low capital growth environment, of getting to the holy grail of income growth from a stable occupier base. Thank you for listening.